Welcome to Sales, Tax, and More, your go-to resource for all things state tax related. Now, here is your host, Michael Fleming.
Hi, Mike Fleming here, founder of Sales, Tax, and More, and today's co-host of the Sales, Tax, and More podcast, where we talk about everyone's favorite topic, which is, of course, sales tax. Today, Ellie Moffat is going to interview me, and our topic is going to be why physical presence matters more than ever. So, Ellie, you want to say hi before we get into the interview?
Absolutely. Sales tax is definitely my favorite topic, Mike.
I know that.
Hi, everyone. Hi, Mike. It's really great to be here. I'll do a quick introduction for Sales, Tax, and More, and we will dive right into the meat of this podcast for you. So Sales, Tax, and More is a full-service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of returns, registrations, consultations, research, and like our name states more, we will give you plenty of ways to reach out to us if you have questions about our services, and you can find that information linked in this podcast as well. So, Mike, I have heard you say that too many sellers that physical presence matters more than ever. Why does it matter more than ever?
A couple of reasons, Ellie, and then great question here. Number one is that many sellers believe they don't have to worry about it anymore. And the reason being is, we've got these thresholds, they're very clear. If you have over $100,000 in sales or 200 transactions, then you've got Nexus. So they're thinking if they have less than that number, that they don't have to worry about it. Unfortunately, this economic nexus doesn't protect you from any other type of nexus. Nexus, fancy word, means link or connection. So an economic nexus doesn't override anything. In fact, it's the exact opposite. A physical presence is going to override an economic presence. So it still matters. Now, why it matters more than ever is because the states have already started. It's been 2 years since we've had this economic nexus, and the states are starting to gather. Before this recession started, before this crisis, this COVID-19 pandemic, the states had started, coming after sellers. So they backed off during the crisis, but they're going to be coming again. And lots of states out there. Maine is especially aggressive. South Dakota is especially aggressive. Utah, they purchase a list of people they think that are over their thresholds, which again are $100,000 or 200 transactions. They were effective January 1st of 2019. So they're going to be calling everyone on this list. They want people to be compliant. Now, here's why this matters more than ever. While these states are out there looking for people who are not compliant with economic nexus, the big states, California and Texas, you only got 8 months of exposure, not too bad. Some of the smaller states, South Dakota, Maine, you have 2 years worth of exposure, or a year and a half worth of exposure in the case of South Dakota. That's bad enough. But while the states are looking to find companies that are not compliant because of this economic connection, this economic link with the state, they're going to find all other types of nexus, this physical presence nexus. And the one that I fear most for companies out there is those who are using independent contractors or subcontractors or anyone else to perform work for them or to perform services for them. Because, most people don't understand, because it's not common sense that third parties can actually create nexus for you if they're helping you to establish or maintain a market. There are 2 U.S. Supreme Court cases that relate to this. One is Scripto. It's a 1960 U.S. Supreme Court case. And the other is Tyler Pipe. It's a 1987 U.S. Supreme Court case. And even though this has been settled for quite a while, Um, a lot of companies don't get this. A lot of companies' advisors don't get this. Your accountants, your CPAs, because it just doesn't make common sense. How can a third party, someone who's true third party, someone who's arm's length from you, how in the world can they create a requirement for you to collect and remit tax? It just doesn't make sense. But unfortunately, when states find you, they're going to say, hey, this has been our rules forever. And, where the economic nexus may be only 2 years old, you may have had these relationships for 5, 10, 15, 20 years. And states routinely go back 7, 8, or 10 years. And they're not limited to that. Texas usually goes back 7 years. But sometimes, we had a case where they were trying to go back 12 years. So that's why physical presence matters now more than ever, because the states are that much active. They're going to be coming anyway because of this economic nexus. Coming out of a recession, the states always step up their discovery efforts, their auditing efforts. So I've been calling this the perfect storm. You've got states that not only is it a recession, but because of the COVID-19 and the extension of tax due dates, the states are really hurting for cash. And they were coming for companies anyway. So they were already gearing up for this. So this is a perfect storm. They're going to be out there. They're going to be looking for sellers who are not registered and they believe they should be. It's one of the fastest ways they're going to be able to fill their coffers and start getting back to normal revenue levels. So they're going to be finding a lot of companies, and, it's not going to be good if they find you for economic nexus, but you can live with that. It's these longer periods of time that can actually put companies out of business.
And Mike, I'm just going to try to read all of our listeners' minds right now here. Do states really want 10 years of back taxes, penalty, and interest?
Depends on the state. So, our favorite answer, it depends. The most common periods that states go back are either 7 years, 8 years, or 10 years. So I don't know of any states that go back 9 years. I say they generally go back that. I mentioned earlier, we had this one type of company that kept all of their receipts in a shoebox, type that most CPAs don't like working with. Real simple man. In his best year ever, he did $70,000, didn't understand that what he was doing was taxable. And the state tried to go after him for 12 years. Now, if you're keeping your records in shoe boxes, I mean, how hard is it to get your records going back 12 years? So when he contacted us, we beat the state back to 7 years, which is their normal look back period. But the reason why I talk about this story is, just because the state says we generally go back 7 years, doesn't mean they can't go back to the date that your nexus, this linker connection, first appeared in the state. And, nowadays, these states don't usually negotiate with you. Some states will still let you do what's called a voluntary disclosure agreement after they find you, specifically the state of Michigan and the state of Florida, to name two big ones. But most states, if they've ever contacted you before and they considered contact a telephone call, a letter, an email, a nexus questionnaire, then a lot of these mitigation programs are just off the table, and they want either their 10 years worth of back tax plus penalty and interest, or their 7 years, or their 5 years, or their 8 years. It could be only 5 years because they can't go back further than the date that your actual linker connection began. So maybe it is only 5 years, maybe it's 4 years, but they do go back 10 years. And a lot of people say, well, I'll just negotiate with the state once they find me. Generally, the state's not going to budge.
Oh, well, okay. So Mike, what should a company do then if they find out that they've had physical presence forever?
Well, they need to make a decision. There are programs out there like a voluntary disclosure agreement. There are amnesties out there. There are what we call historical registrations. That's where you get registered with the date that your nexus actually began and then file all the back returns with the penalty and interest. You can also ask for a penalty waiver. And then there are prospective registrations, and this is not what the states want you to do. But in reality, a lot of companies say, hey, I want to stop the bleeding. I don't want to continue building my liability up every day, but I don't have the ability to go back and pay all these states, all of this back tax. And these types of companies decide that, yes, I know what my risks are. I want to stop this bleeding. I can't let my exposure continue to build, and I am going to just register on a prospective basis. Now, a lot of states, you just can't do that. State like Maine at this point is going to be auditing everyone back to July 1st of 2018 when their economic nexus began. State like South Dakota is going to put the screws to you during the registration process, and they're going to require anyone who had nexus prior to the date they're using on their application to go back to November 1st of 2018. But as of now, some states, you can fly underneath the radar. Now, I'm not suggesting that, and that is definitely not what the states want you to do. However, I'm telling you about reality. This is what a lot of companies are choosing to do. So that's one thing. But what the states want you to do are either historical registrations, managed audits, the amnesties, which are generally few and far between, and then, of course, VDAs.
So, Mike, you talked about VDAs here. I think most people have heard of them. Is that always the best option? Is it even a good option for people?
No, it's not always the best option. And let me go back to your previous question, by the way. The worst thing to do is nothing. You got to do something. You can't let all of this exposure continue to build, because it's not going away. Every day it's going to get worse. So if you choose to, at the very least, stop the bleeding, get registered on a prospective basis, do it. If you choose to do one of these other methods, then do that. But you cannot do nothing. I implore you. It's going to get worse. And the states are coming like they've never come before. So I just want to make sure that everyone understands that. Now, a VDA is a tool. And just like any tool, there's not really a one-size-fits-all tool. Depending on what your facts and circumstances are, it may be a perfect tool for you. But I'll give you an example. Someone came to me the other day, and one of the software companies was telling them, whenever you owe more than $500, then you should do a VDA. Now, this company happened to be charging $3,500 for a VDA. Now, let me ask you this. Does that make sense? Why pay someone $3,500 if you only owe the state $500? Doesn't make sense. But this software company is certainly getting a lot of people to do VDAs when they only owe $500. I mean, to me, that's a travesty. You'd be a lot better off just paying the state the $500. I mean, you're paying an extra $3,000 to a company so some salesperson can get a commission. I mean, that's ludicrous. What we say here is, you got to be saving at least an amount of money that equals or exceeds the cost of the VDA. Otherwise, why does it make sense doing the VDA? Now, we're a lot cheaper than $3,500 when we do VDAs. Our cost is $1,975, but the concept is still the same. If you only owe $500, why pay us $1,975 to do a VDA? You're a lot better off just getting registered, doing a historical registration, telling the state, hey, here's when my nexus began, and doing the back returns. It's going to be a heck of a lot cheaper for you. You're going to save money in the long run, even if you have to pay the penalty and interest. So no, a VDA is not always the best option. You've got to look at what your potential exposure is. If there's tax collected, not remitted, and it's a smaller amount, okay, there's additional penalties there. Sometimes there may even be what we call criminal penalties. Doesn't mean you're going to jail. It just means that, it's an extra black mark against the company, and it does come with, much increased penalties. And in theory, you actually could go to jail if it's blatant and, the amounts of money involved are very high. I mean, if you Google sales tax jail in Florida, you're going to see that Florida puts a lot of people in jail. But it's usually convenience stores, restaurants, used car lots, things like that, where you have cash businesses and people are actually cheating on their taxes. But in general, you don't, want any of these criminal penalties. So there's exceptions to every rule. A VDA, even with a small dollar amount, if you have tax collected and not remitted, might be the best tool for you. But in general, the longer your exposure, I mean, if you have, 10 years of past exposure, VDA may be a great tool for you because it's going to limit your look back period. As a benefit for stepping forward voluntarily, the state's going to say, okay, we're only going to look at the last 3 years, or we're only going to look at the last 4 years worth of taxes. Anything older than that, we're willing to forgive. So let's take a state like California. If they find you, they're going to go back up to 8 years. But if you step forward and say, hey, I want to enter into your voluntary disclosure program, they're going to say, okay, thanks. And, as a reward for not making us track you down, we're only going to look at 3 years. So right there, you save 5 years worth of back tax plus penalty and interest. So that's a great benefit. But you still have to pay 3 years of back tax. So make sure that you can pay the 3 years of back tax, or you can work out a payment plan with the state of California. They're also going to waive penalty. So California waives penalty. Their penalty is generally 10%, so you'll also get that waived. Now, hardly any states, there may be a handful, 5, 6, 7, that do something with interest. State of Texas, for example, they normally only go back 7 years. We mentioned how they were trying to go back 12 years, but they normally, if they find you, will only go back 7 years. Their VDA is 4 years. So you're only saving 3 years of back tax, penalty, and interest, but they waive 100% of the penalty and 100% of the actual interest, which can add up over a 4-year period. So a VDA is a tool. Sometimes it makes great sense to do it. Sometimes not so much. So, if you need help determining the best way to move forward, go ahead and reach out. You can speak to, one of our salespeople. We call them team members. They'll walk you through this, or schedule a consultation with me, and I'll be happy to help and answer your questions and draw out a plan for you. Any other questions, Ellie?
No, but Mike, if people want to reach out, if they want to schedule a consultation or speak to one of our team members, how could they go about doing that? What's the best way to get a hold of us?
Yeah, this website is going to be the best way. So the website address is salestaxandmore.com, all spelled out. So www.salestaxandmore.com. And there's lots of great resources on there. There are a lot of free resources on there. We encourage you to go and see all of the free stuff that we have, and also our webinars. We offer a series of webinars that do provide for CPE credit, and we're constantly updating them. I think we offer maybe 7 different webinars at this point, and we're constantly doing them on a live basis, 2 to 3 times a week. So the website, great for resources. You can schedule a consultation with me directly on there if you want. You can ask to speak to a team member. You can also see all the different services that we do offer. If you want to skip the website, you can always reach out to Ellie directly, and she'll either get your question answered or point you in the right direction. Just remember, some questions aren't very simple. It's like peeling an onion, and a consultation may be required. So Ellie can be reached at eMoffat, that's MOFFAT, at salestaxandmore.com. Well, we appreciate everyone's time today. Thanks for listening, and we'll talk to you soon. Bye-bye.
Thanks for listening. Be sure to click subscribe and check out all of the resources we have out on the web